Welcome to StokTok's deep dive into Honeywell International. Honeywell is one of the world's largest industrial conglomerates, operating across aerospace technologies, building automation, industrial process controls, and advanced materials. At the time of recording, the stock is trading at 233.55, sitting comfortably above its 200-day moving average of 210.3. and just below its 50-day moving average of 234.6. The 52-week range runs from 181.07 on the low end to 248.18 at the peak, placing the stock in the upper half of that range. The 14-day RSI, a momentum indicator, reads 54, which is neutral territory. The technical setup is neither overbought nor oversold. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Honeywell International is a diversified industrial technology company whose core revenue drivers span aerospace systems, building management software, industrial automation, and performance materials. Its competitive moat is built on deep customer integration, long-cycle government and commercial aerospace contracts, proprietary process control software, and decades of installed base that creates significant switching costs. The company earns a StokTok score of 35 out of 100, a caution signal. Breaking that down across 5 dimensions: valuation scores 0 out of 20, financial health 13 out of 20, profitability 11 out of 20, growth 3 out of 20, and smart money 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Starting with the price-to-earnings ratio, what the market pays for each dollar of current earnings, Honeywell trades at 29.23 times trailing earnings. That is a meaningful premium for a mature industrial conglomerate. The forward price-to-earnings ratio, which uses the next 12 months of estimated earnings, compresses to 22.20 times. A noticeable step down that implies the street is expecting earnings growth ahead. However, the PEG ratio, which adjusts the price-to-earnings multiple for growth, where a reading above 2 is considered stretched, comes in at 6.63. That is a significant red flag, in our view, suggesting the current multiple is difficult to justify on a growth basis alone. The EV to EBITDA multiple, enterprise value relative to operating cash earnings, a capital structure neutral valuation tool, stands at 20.92 times. For context, diversified industrials have historically traded in the 12 to 17 times range, so the company appears to be pricing in a premium relative to peers. The GuruFocus Value, an intrinsic value estimate based on historical multiples and growth, stands at 218.86 at the time of recording, compared to the current market price of 233.55. That implies a margin of safety, the discount or premium to intrinsic value, of negative 6.71%, meaning the stock is trading at a modest premium to that estimate. Wall Street analysts at the time of recording have a consensus mean target of 251, drawn from 25 analysts, with a high target of 296 and a low of 198. The recommendation is buy. The next earnings report is due April 23, 2026, with the street expecting earnings per share of approximately 2.32, ranging from 2.28 to 2.39, a near-term catalyst worth monitoring. Market sentiment around Honeywell, as of the creation of this video, leans bullish, with analyst recognition as a leading play on military drone technology and broader defense sector tailwinds, providing positive momentum. Overall, in our view, the valuation picture warrants caution. The score of 0 out of 20 on this dimension reflects a setup where the current price appears stretched relative to both intrinsic value estimates and peer multiples. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency. Honeywell scores 5 out of 9, a middling result that indicates a balance of positive and neutral signals rather than a clearly strengthening or deteriorating picture. The Altman Z score, a multi-factor model used to assess bankruptcy risk, where a score above 2.99 is considered safe, reads 3.41. That puts the company firmly in the safe zone, which is reassuring. Turning to the balance sheet, the cash-to-debt ratio of 0.36 means the company holds 36 cents of cash for every dollar of debt, a moderate liquidity cushion, not a fortress. Interest coverage of 4.89 times, that is operating earnings divided by interest expense, is adequate but not exceptional. For an industrial conglomerate with significant capital requirements, we would want to see that ratio trending higher over time. The current ratio of 1.30, which measures short-term assets against short-term liabilities, signals basic near-term liquidity. The debt-to-equity ratio of 2.56 is elevated, meaning the company is carrying roughly $2.50 of debt for every dollar of shareholder equity, and is the most notable credit concern here. The overall financial health score of 13 out of 20 reflects a business that is solvent but carrying a leverage load that limits balance sheet flexibility. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, which measures how effectively management deploys capital across the entire business, debt and equity combined, at 9.36%. For an industrial conglomerate, that is a respectable but not outstanding figure, and we would want to see it trending upward given the elevated debt load. Moving down the margin stack, the gross margin, revenue remaining after direct production costs, comes in at 36.93%. That is a healthy reading for an industrial business and reflects the pricing power embedded in Honeywell's proprietary technologies and long-term contracts. The operating margin, what remains after all operating expenses, including research and development and selling costs, is 17.54%. That is a solid operating leverage profile. Net margin of 12.63% represents what ultimately flows to shareholders after interest and taxes. Crucially, the free cash flow margin, cash generated after capital expenditures, which is the most honest measure of economic output, stands at 14.48%. The fact that the free cash flow margin exceeds the net margin is a quality signal, suggesting the business converts reported earnings into real cash at a healthy rate. The profitability score of 11 out of 20 reflects genuine operational quality. The margins are real, and the cash generation is credible, but return on invested capital at current levels keeps this from scoring higher. On to growth. Is this business expanding, and at what rate? This is where the data raises the most material concern, and it is reflected in the growth score of just 3 out of 20. Revenue growth over the trailing 3 years has averaged 1.80% annually. Over the trailing 5 years, that figure rises modestly to 4.00% per year. Neither number is alarming for a large industrial business, but in the context of a price-to-earnings multiple above 29 times and a PEG ratio above 6, growth of this magnitude is difficult to reconcile with the premium being paid. Put simply, the market appears to be pricing in an acceleration that the recent track record does not yet confirm. Book value growth, the change in net assets per share over the trailing 3 years, is negative 4.40% annually. Declining book value combined with elevated debt to equity suggests that capital is being returned to shareholders or deployed in ways that reduce the accounting equity base rather than compound it organically. The dividend yield of 1.99% offers some income to patient holders, approximately 2% at current prices, which is a modest but real component of total return for long-term investors. However, income alone does not resolve the growth deficit. The bear case rests largely on this dimension. If revenue growth does not meaningfully accelerate, the current valuation multiple will be very hard to defend over a full market cycle. Now let's talk smart money. What institutional capital is actually doing with this name? 18 top-tier investment managers, what the industry calls guru investors, meaning managers with long-term track records of outperformance, currently hold positions in Honeywell International. Among the notable names, Robert Alstein of Alstein Capital Management holds the stock at 1.04% of his portfolio and has been adding, increasing his position by 20.93% recently. Torrey Funds and Dodge & Cox Funds also appear among the holders, though both have held their positions steady with no change in recent filings. The presence of value-oriented managers like Alstein, who is known for rigorous balance sheet analysis, is a signal worth noting. These are not momentum players. However, the broader institutional picture is less compelling. Only 14.1% of 13F filers, that is investment managers who disclose holdings to regulators, are net buyers at this time. The threshold we watch for genuine institutional conviction is above 50% net buyers, so at 14.1%, the data suggests the institutional community as a whole is not rushing to add exposure. Insider ownership stands at just 0.53%, meaning management and directors hold a very small stake relative to shares outstanding. That is a low alignment figure. Over the most recent 3-month window, there have been 0 insider purchases and 6 insider sales. Insider selling alone does not constitute a sell signal. Executives sell for many reasons. But combined with near zero ownership and below 50% institutional buying, the smart money picture scores 8 out of 20, which we read as muted conviction. And finally, the verdict. Let's bring it all together. On valuation, the data suggests the stock is trading at a premium to intrinsic value estimates with a PEG ratio above 6. In our view, this is the most significant headwind for new investors at current prices. On financial strength, the Altman Z score places the company in safe territory, but an elevated debt-to-equity ratio of 2.56 and moderate interest coverage of 4.89 times indicate a balance sheet that requires disciplined management. On profitability, the operating margins and free cash flow generation are genuine positives. A gross margin near 37% and a free cash flow margin above 14% reflect a business with real pricing power and cash conversion quality. On growth, the trailing revenue expansion of 1.80% over 3 years and negative book value growth are difficult to reconcile with the current multiple. This dimension, in our view, represents the core tension in the investment thesis. On smart money, the presence of 18 Guru holders including value-oriented managers provides some support, but only 14.1% net institutional buying, and a pattern of insider selling temper that signal. Overall, the StokTok score of 35 out of 100 reflects a business with genuine operational quality, credible cash flows, and defense sector tailwinds, but one where the setup looks stretched on valuation relative to recent growth delivery. We would want to see either a meaningful re-rating in growth expectations or a more attractive entry price before the risk-adjusted case becomes compelling. In our view, everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Honeywell International. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.